Now let's talk about the statement of cash flows. Statement of cash flow is a forced financial statement, and they are reported in three primary business activities. First, we have the cash flow from operating activities. These are cash from the company's transactions and events that are related to the primary operations, the main business. For example, we sell inventories, we have cash inflow, and we purchase raw materials, that is cash outflows from operating activities. Next, we have cash flow from investing activities. These are cash from acquisition and divestitures of the investment of long-term assets. For example, we have cash outflow when we purchase equipment. We have cash inflows when we sell long-term investment. And finally, we have cash flow from financing activities. We have cash inflows when we issue stocks and we borrow money, and then when we pay back the money, we have cash outflows. So examples of operating activities. Operating activities include cash received and paid related to selling goods, providing services, and are directly related to the company's primary day-to-day business activities. So let's see what are those. Cash received from customers for sure, or in anticipation of future goods or services, including cash received in advance, right? Okay, here we have cash received of interest and a dividend. Be careful. We have interest revenues, dividend revenues. Okay, if we receive cash, those are cash from operating activities because they are part of the day-to-day regular business, regular investment. Other cash received that are not related to investing or financing, such as rentals, lawsuit settlement, and refunds received from suppliers. These are related to daily business activities. Cash outflows, right? Like payment to payment to employees, payment to suppliers, purchase inventories. Okay, and here be careful. We have interest payment to creditors. These will be viewed as daily business activities. Interest payment is also operating cash outflows. The tax payment to government and contribution to charities, lawsuit settlement, those will also be viewed as cash outflow of operating activities. Next, investing activities. Investing activities include acquiring and disposing of PPE assets, buy and sell. And here the buy and sell of investment. Then we have lending and subsequent collection money. This is part of investment. So cash inflows, right? We sell PPE assets, sell investment, and the loan collection from borrowers. And same thing for cash outflows when we purchase PPE, right? Purchase investment, and when we lend money to borrowers. The purpose is to invest. Then the financing activities include receiving cash from shareholders, returning cash to shareholders, right? Borrowing from creditors, and repaying creditors. So if we acquire treasury stock, if we purchase our own stock from investors, that's cash outflow from financing activities, right? If we pay dividend to shareholders, that's financing activities. The cash payment to settle outstanding bonds payables, mortgages notes payable, and other notes payables, or cash outflows from financing activities. So these are the three main sources of cash flows. Why we need to have this classification? Because these three sources are totally different and have different implications to company's future performance, or and different implication also for to explain the company's current performance as well. For example, if we have the same amount, $100,000 cash inflows, but they from different sources, they have different implications. For example, we have $100,000 cash provided by operating activities. We know it's good because it's likely to reoccur in the next period. It's sustainable. Next example, that's the same amount of cash provided from investing activities, mainly through the selling of PP assets. It's okay, but it's not likely to recur. What about next period? Do we have the same amount PP assets to sell? Maybe yes. Maybe not, right? And so it's less likely to reoccur. And finally, we have a company that's main the same amount of cash flow is from issuing notes payables. Right, it's called a dauntless, should be the worst scenarios because repayment is required. Not only it's not going to recur that frequently, you may have to may borrow again next period, but you have to repay those. So how about in the next period? You have to have cash outflows because you need to repay. So if you look at three examples, right, cash flow from operating activities is the best. These cash flows are sustainable, and they are positively related to company's performance and also future performance, right? And cash flow from finance activity could be the worst choice. So back to a few years ago when Tesla was in its worst years, Tesla at the age of bankruptcy, Elon Musk had to go everywhere to borrow money, right? So Tesla had a lot of cash inflows from financing activities with little or negative cash flow from operating activities because at that time they just couldn't generate positive cash flow from the electric vehicles. But now, after a few years, things have changed. Then their operating activities are back to normal. They can have cash to repay those liabilities. Another way to use this cash flow information is to compare these numbers with the earnings, net income. If the net income is mostly consistent with the operating cash flow from operating activities, then we say that companies in the normal path, and its earnings are more sustainable, are not more likely to persist into the future periods. But if you see a huge difference between net income and operating activities, cash flow operating activities, but you have a large amount of cash from other activities, especially from financing activities, then we have to question, will those earnings or will those net income be persistent into future period? Probably not, right? So how to prepare the statement cash flows? Unlike the previous three financial statements, the cash flow statement are prepared in different ways. So we have two options. We have the direct method, in which we examine all cash transactions occurred during the period. Then we're going to group them according to the type of activities and inflow and outflows. Right? So there's a lot of work because we need to check each cash-related transactions. So it's often not practical. Okay. For project for textbook examples, it's durable, right? If you have 20 transactions, you can obviously categorize them and finish the income statement from there. That's durable. But in practice, that's not durable. So instead, what we can do is we have indirect method, which is commonly used. Under this method, we're going to reconcile the income statement and the balance sheet information. Okay, we're going to work from the net income, and we're going to figure out what is our cash flow from operating activities. The idea of the indirect method is we're going to find out the difference between revenue expenses and the cash receipt and cash expenditures. If we can find the differences, we can easily turn the net income from the income statement to the statement cash flows. So what we're going to do is we're going to find out non-cash related revenues and the non-cash related expenses. Okay, and those things can be found on the balance sheet. Or the other way to think about this issue is, I should say, this is a correct thinking, better thinking than my previous sentences. So we're gonna find out those cash payment and a cash receipt that do not have revenue or expense implications. Okay, it's better to understand. For example, just give you an example. When we purchase inventory with cash, we have cash outflows, right? But we don't have any expenses until we sell them. If we purchase inventory only, we don't have any expenses. So here we have a difference between expense and cash outflows. Right, the increased amount of inventory explains the difference. And the same thing for borrowings, short-term borrowings. If I obtain a short-term loan, for example, a short-term credit, right? I get cash, but there's no expense or revenues, right? That explains the difference between the revenues and cash receipt and expense and cash expenditures. And also there's a depreciation. Remember the depreciation? Depreciation, we're going to book a depreciation expense, right? We take depreciation expense. It has expense implications, but it does not have cash implications. So that explains the difference between these two. So to summarize the differences, how can we convert net income to cash from operations? Okay, we're going to add back any non-cash implication expense. Add back non-cash implication expense. Now that's a depreciation expense. And other differences can be adjusted by subtract an increase in operating assets and add back any increase in operating liabilities. Why that is the case? For example, if we have increase in inventory, right? We must have paid cash to purchase. So it increase our inventories, but it has no implication for net income. Therefore, we're going to subtract an increase in inventory to adjust the difference between net income and the cash flows. The same thing for example, we have account payables. That's operating liabilities, account payables. If we have decreased account payable, what does it mean? If we decrease account payables, we must have paid cash to settle those operating liabilities, which have no net income implication. So we're going to add back those changes, increase in operating liabilities. So after we do this adjustment, we're going to have the cash from operations easily. This is what we do. We start with net income, and we're going to add back depreciation expense, which has no cash implications. We're going to subtract any increase in our operating current assets. So these are current assets account, including account receivables, inventory, prepaid insurance, interest receivable, and add any increase in current liabilities, account payables, earned revenues, wages payables, interest payables, income tax payables. After these adjustments, we're going to have cash flow from operating activities. See the huge difference between net income and operating activities. So this is called indirect method. Indirect method. Alright, finally we have the statement cash flows, titles for period, and cash flow from operating activities. These are, we can get these from indirect method. So the cash flow investing activities and cash flow from financing activity, these will be worked with a direct method because the company may not have too many investing activities or too many financing activities. We can easily identify those inflow and outflows and report them in these two categories. Okay, after that we have the net changes in cash plus the beginning cash equals the ending cash. Okay, this if we complete a statement cash flows, and this cash ending balance will reconcile the one on the balance sheet. So it connects to the balance sheet, and this netting and the net income from these statement connects with the income statement. And finally, we must have some disclosures as well. These are the non-cash investing and financing activities. So not all significant investing or financing activities will affect cash flows. So they are not reported on the statement cash flow, but they need to be disclosed. For example, we can issue stocks in exchange for land. So we give seller land and we get land. So there's no cash involved. So that will not be reported. Or we purchase a building by borrowings. Right? There's no cash effect at all. We borrow money and we use money to get building. So virtually there's no cash implications for these transactions. However, these important transactions will be valuable to investors. So non-cash investing financing transactions are supplemental to the statement of cash flows. They will be disclosed at the end of the financial statement. So 3 disclosures are required. Right. In addition to the non-cash investing activities, we also need to disclose cash paid for interest and for income taxes if the indirect method is used, and the related policies will be disclosed. Right, so far we have talked about all the financial statement, how we're going to generate those financial statements, but we have a final step to finish before we finish accounting cycle, which is we need to close temporary account. Remember, all the revenue expenses account there for a certain period, and after each period, those accounts will be closed, and we're gonna get rid of the numbers right to 0, so we can prepare for the next period. This is just like a scoreboard. After each game, the scoreboard will back to 0. So we're gonna close those accounts at the end of accounting period. And this is only for temporary accounts, including revenue expenses. We have permanent account asset, liability, and equities, where numbers will flow to the next period. And closing those accounts is very straightforward. We're going to close revenue account. Right? Revenue account will have a credit balance, so we're going to debit those accounts. And then we're going to credit return earnings. So we reduce all the revenues and increase return earnings, or numbers flow to return earnings. To close the expense account, because they have debit balance, I'm going to credit all those expense account and debit return earnings. So all the numbers flow to return earnings. And this shows the process of closing. So the numbers will flow to the return earnings, and they're going to zero out those temporary account. Return earning is a permanent account on the balance sheet. Alright, so this is a closing process. By the end of the period, we're gonna close the revenues and close all the expenses, and we're gonna update return earnings into its ending balance. We can have the post-closing trial balance if you want. Not necessarily needed, but if you want, we can have this post-closing trial balance, and it provided the very last ending balance for those permanent account. Okay, all temporary account has been zero out, closed. So there's no longer we need revenue expenses account. But we don't necessarily need this one. Right, that's the end of the accounting cycle. Typically occurs each fiscal year, and this is represents a systematic process for accumulating and reporting companies' financial data. That's it. And we're going to have a project for you to simulate the accounting cycle project.